how to work out the interest rate on your loan. So going to be a quick video today. My name's Dervish. I'm the founder of the Black Belt Property Academy. I've been investing in property since 2007, and hopefully this video will provide you with a little bit more information and hopefully some value. If you do get any value from it, or if you're not already a subscriber to the channel, please make sure you hit that subscribe button. Do me a big favor, please. So what we're going to do is work out the interest rate. Now, it's very important. I say this at all the start of these videos when I've got the old trusted flip chart out. We need to understand, my handwriting's not the best, okay? So what we're going to do is work out the interest rate. Now, first of all, people might go, white belt investors might say, well, why do I need to know the interest rate? Knowing the interest rate or knowing how to calculate the interest rate on or before viewings will give you a good idea if the property cash flows or not. Now, again, the metric isn't just always cash flow. You should be looking at return on investment, return on capital employed, and so on. But cash flow is always a good measure, especially for our new white belt mentees. Now, at the Black Belt Property Academy, though, just in case you didn't know, if you haven't read any of the blogs or my book and so on, we take white belt new investors through to confident black belt investors. Okay, it's not just information dump or anything like that. It's a transformation. I'm a 6-degree black belt, and I've taught over 10,000 students over a 20-year period on how to get the best out of themselves and how to learn complicated techniques to achieve that mastery. Now we do the same with property investors. So, interest rate. Now, very, very basic maths. There's a couple of ways to work out the interest rate, or there's probably more ways, but I tried to teach 2 ways depending on which way people prefer. So, let's base it on, I love the easiness of the maths. Let's base it on £100,000 property there, okay? So we've seen a property, it's up for 100,000, or you've secured it for 100,000. Hopefully it was up for 120 or 130 or whatever. Hopefully you haven't paid the asking price, unless you can see some amazing opportunity that the estate agents can't see, or whoever it's up with. So first of all, then we need to realise that if this is a buy-to-let mortgage, we're going to get a 75% mortgage on that, which means obviously the lender, whoever it is. So if you're new to the buy-to-let scene or anything like that, it might be TMW, the mortgage works, it might be Fleet, it might be Precise. There's many buy-to-let lenders out there because there's a lot of money in lending money. So 75%, sorry, I did that wrong. Okay, so 75, did I recoup that or not? So that's how much they will lend us. So that's how much the bank, whoever it is lending us to buy that property. Now, if the interest rate is currently now, we'll do it this way. We'll do it on interest rate of 5.5%. Again, I could have done something like 5.29 or anything, but I just want you to understand the basics of it. Now, we must understand that if we are looking to build out a portfolio, depending on which stage of your journey you're at, most of our mentees choose to put it on interest-only mortgages because they understand the power of, or the hidden power of, inflation, and they want to make sure that Father Time does its work on this fixed debt. Now, again, I jump around a lot in these videos, but that's going to be a fixed debt based on an asset that over time will increase in value. And not only is that a fixed debt, the amount of actual money in real terms will also reduce based on inflation. Again, I'm not saying over the next 1, 2, 5, 10 years, but for instance, now one of the properties that we purchased in 2007, I think it was the first, maybe the second ever one, didn't negotiate, got all the cowboy trades in, didn't do tenant checks. We purchased for 60. We had a mortgage of 60, I think it was. Obviously, I'm going back here. Now, properties on that street are worth comfortably now, not even in a brand new refurb state or anything, 150. However, at the time we still had a mortgage of £60,000. So what I'm trying to explain there in a roundabout way is the value of our money goes down each and every year. Again, if any of you watch Grant Cardone or anything like that, he always mentions that. The value of our money goes down each and every year. Kiyosaki mentions it as well. It's just that we don't see it because it's that small. Let's remember as well, the government's got an incentive or an inflation target to meet every year to help them whittle away down their national debt and so on. So let's get back to this. So interest rate for a particular mortgage. Now, the property was £100,000. Our buy-to-let lenders will let us get 75% of that, which is 75,000, and then our interest rate is 5.5%. So what we'll do is we will do 75, 1, 2, 3 multiplied by 0.055. Okay, that is obviously the loan amount that they're lending us, and then that's the interest rate. Okay, so let's put that there. It's getting a little bit messy, this, isn't it? That's that. Now this will give us the amount that the mortgage is on an annual basis. Going back to an old school, well, iPhone, it's not a calculator, but you know what I'm getting at there, don't you? Okay, so what we're going to do is 75,000, 1, 2, 3, multiplied by 0.055 equals 4,000. This is how much we'll need to pay each year, £4,125. That's just to service the debt, okay? So that's how much we'll need to pay per year. To get that then into how much per month, we simply divide it by 12 months, because hopefully there are still 12 months in the year. Divided by 12, and our lovely payment is £343 and what was it? 75 pence. Okay, £343 and 75 pence. We must, as beginner intermediate investors, understand how to work out the interest rate on a particular property that you're looking to invest in, because then that'll tell you how much cash flow is. Now, let's turn it over to the next one then. Do you know what? Before I do that, though, another way how to work this out, I'm not going to write it down on here, though, is if that's our loan, so there, where is it? 75,000, we can divide it by 100, which will give us then 1%. And then what we do with that 1% is times it by 5.5, and you'll find that it still gives you that amount, okay? So what was I just about to explain then? Let's have a look. Yeah, so let's just jump onto cash flow while we're here. So if that's 343, okay, so let's have a look. How much is property going to cash flow? I'll write that down there so I will not forget. We said 343, didn't we? Okay, so how much are you going to cash flow? Now, I know I mentioned this and I probably said it already. Cash flow is only one metric. Cash flow, though, is an essential metric, because it's only until cash flow dwindles and disappears that you appreciate it, okay? So trust me, cash flow is essential. It's a lifeblood of business. Now, if this particular property is renting out for £800 per calendar month, so there we go, we've got that £800 per calendar month here. Now, we've also as well decided to value our time a lot more and outsource this to a managing agent. So they're going to want minus 10% on average plus VAT. Okay, so 10% of 800 is 80, I think, plus the 20%, so it's like minus £96. Okay, now we're going to, just for argument's sake, then minus insurance, and we're going to do that at 20. Again, it will fluctuate. I'm just trying to give rounding numbers here. And then this one here, the 343 is going to go in, and then we should be able to work out what our cash flow is. So cash flow there, let's have a look again, because I don't want anybody saying you got the maths wrong and you did this and you did that. I want you to understand. Let's go back to this one now. I want you to understand how important cash flow is. So it's going to rent for 800 per calendar month, minus 96, which is the managing agent fees, minus £20 approximately for buildings insurance. And then this is always the biggest expense, minus your finance cost, minus 343. That cash flows £341. Okay, £341. Is that good? Is that bad? That's up to you to decide. And again, one thing I always tell my white belt mentees, especially during the orientation period, it's your why this, okay? It's not, to mention it again, Grant Cardone's why, or Robert Kiyosaki's, or any other person that you might follow. The reason that you're investing in property is to achieve your goals, not somebody else's goals, all right? So cash flow there of £341 is far better than a kick in the teeth, definitely is. And especially when, let's put it down here, it is somewhat, I'm mentioning somewhat, I mean serious business now, passive, okay? So if it's passive, 95%, and that's going into the account each and every month, over £3,500 a year, then that's not a bad situation to be in, okay? And it's up to you then to try and build up 2 of those, 5 of those, 10 of those, 15 of those. And start to invest in high yielding things like SA, serviced accommodation, HMOs. Maybe then take it to the next level and do commercial to residential and so on. Maybe start to then buy multi-unit freehold blocks, small blocks of flats and so on. What I want on my mentees to understand is you're going to come to us as a white belt new investor. We're of course going to teach you some of the strong fundamentals because we need to. This is a fundamental. You need to understand those strong fundamentals, but at the same time, you then need to understand the more advanced strategies, and then start to tailor it to your needs of what you want to achieve in your life. At the moment now, you might be looking to just build out another passive income stream, another income stream. You may be looking to quit your job. You may be looking to transfer some of your profits from a successful business that you have and that you enjoy working in and utilize it more in property. Then again, the rewards are there, but we must be educated, okay? We've got to understand that the education, again, the more you learn, the more you earn. Now, some people say to me, well, I can't afford mentorship. In hindsight, I would have achieved a lot more and be a lot further on in my property journey if I hadn't had that scarcity mindset and if I'd invested in a mentor during the early days. The only time I really realised is with my martial arts school. Again, I don't know if I said this at the start, I'm a 6th-degree black belt at a very successful martial arts school, taught over 10,000 students over a 20-year period, graduating hundreds to black belt, also built many senseis, many instructors as well. We've got to understand that there's levels to go through, and at a certain point I thought my school was doing well until I invested, and I use the word invest, not spend. I invested for 3-4 years into a martial arts business mentorship, and then that's when, which is what's going to happen with your property knowledge and so on and cash flow, that's when that, I'm going to go straight through, started to happen with profits and so on. Okay, remember, readers are leaders. Okay, the more you learn, the more you earn. Anyway, thank you very much for watching this video. I hope it's provided some of you with some value. We did start off on, if you can remember, how to work out interest rates. Okay, definitely something that we need to understand. Hopefully we can understand all that. Now again, please subscribe to the channel if you're serious though, and if you're committed. That's the one thing, okay? If you're committed to improving your knowledge, your cash flow, your wealth, then check out probably the link in the description or in the comment, but check out my website, dervishdervish.com. Have a look at the Black Belt Property Accelerator. Maybe, again, depending on your level, maybe possibly the Black Belt Property Academy. Good luck, all the best, and I will try and smile next time. I will try and keep my head in the shot. All the best, good luck.